So look, we've heard throughout the day today, and you'll hear later today, and as you've probably been well versed with managed accounts, particularly those of you that have embarked on that journey, is that the technology behind the managed account provides so much business efficiency and productivity. But one other benefit that a managed account provides you is that your investment universe expands and opens up. You're able to access listed products, securities, as you know, warrants, if that's part of your planning practice, LICs, and also exchange-traded products and ETFs. I'll focus in the time that I've got on ETFs. The market capitalisation of ETFs has exceeded 37 billion. There's more in ETFs now than LICs. And it's interesting that market value, the total FUM of ETFs, has actually doubled in the past 2.5 years. It was half that value just 2.5 years ago. And managed accounts, just in the last 2.5 years also, have strongly adopted exchange-traded products and ETFs. And it was interesting, up until 2 or 3 years ago, the largest segment or holders of ETFs were self-managed super funds. They're still big holders. They were the first and early adopters. But it's very interesting to see that managed accounts now are adopting ETFs in their model portfolios. And the reason we put this down to, certainly from our observations at BetaShares, is what I've got highlighted here, the evolution of exchange-traded products. The ASX and other stock exchanges around the world have actually invested a lot in terms of their own technological advancements and trading systems and settlement systems, whereby we now have a T+2 standard, where ownership of an asset can actually change in 2 days. At the heart of it, an ETF is simply just a managed fund. It's a unitised managed fund. Obviously, it has a lot of the benefits and advantages of being listed. There's an additional level of liquidity, there's transparency, real-time pricing. But that managed fund can actually house more than just traditionally what it housed, which was market cap indices. And this is what we call the evolution and also the democratization of investing. So the ETFs 1.0 were pretty simple. They were mostly index tracking, mostly tracking market cap indices. We at BetaShares have been pioneers in putting other relevant exposures and that are relevant for you as portfolio constructors in that very humble unit trust structure, which is now an ETF. Things like our BetaShares AAA High Interest Cash Fund. This one's very interesting because I personally know many of the institutional investors in that fund. It's well over 1.3 billion, and not a single one of them sought to invest in an ETF. What they were seeking was a pickup in their cash rate. And it just so happened this ETF was the way to get that pickup in the cash rate. So there's an example of an asset class exposure that's very easily accessible. 2.0 has been interesting, particularly in the smart beta space. One of the big negatives of not investing in ETFs and particularly market cap index calculations is the fact that the limitation is that it's using price in the equation. Either you believe that today's share price is perfectly efficient and captures the value of a company, whereby you believe in the efficient market hypothesis, or you reject it and you believe there are errors or other things driving the price. Most active managers don't believe that today's price is right. They believe the price is somewhere else, and that's why they make active decisions. And this whole concept around smart beta and factor investing really taps into that, not using price as the equation and other things you can use in terms of either sizing a company or targeting particularly factors. And they've been very widely adopted in the managed account space. And then the next evolution is rules-based strategies, where a set of rules is put in place to extract something from the market. The something can be extra dividends. The something can be a short exposure to hedge your portfolios. And in recent times, the next evolution of 3.0 has been active ETFs. And it's been a regulatory development that's allowed that. Magellan with their MGE ETF was the pioneer in this space. And what that's allowed is, well, it's allowed a few things. It's allowing investors to very easily access quality active managers. They don't have to go through, and it makes it a lot more frictionless. They don't have to, particularly for an SMSF, have to get the wet signatures for a PDS. They may not have to go through, the extra costs of a wrap account or a master trust. So I just wanted to highlight this just in terms of just the evolution and dispelling the misnomers that all ETFs are index tracking. And just going back, and so that's one point I just wanted to make. The second point I just wanted to highlight was that with a managed account, if you go down that path, in terms of your portfolio construction, you have an opportunity there to actually implement your investment beliefs and philosophies. We heard from Lucas this morning about your philosophy really is your rudder, and you have to have that belief and rudder. And the beauty is in a market is that whatever investment philosophy or approach you have, the building blocks are there. Not just the building blocks, but strategies in their own rights. I've listed out a few here that we've come across with some clients. A strategic long-term only, SAA with dynamic tilts, if you believe that asset classes themselves can be misvalued. Core satellite approaches, where a core can be an index or even active managers, and then satellite tilts. Other interesting philosophies we've come across is absolute return, objective-based. Income layering, and this is really at the heart of what Milliman, that Jeff mentioned this morning in terms of income and bucketing strategies, incorporating ESG beliefs and risk parity portfolio construction methodologies. So that's what we've experienced, but and then the second part in terms of the actual solution, the building blocks are there. So no matter what your belief is, and it doesn't have to be just, I believe in index market cap, passive SAA only. We've seen a whole range of different philosophies, and the building blocks and strategies are available. There's a whole array of different segments of the market for Australian equities. Global equities have also been very strongly adopted by managed account model portfolios. Managed risk is a very interesting one, particularly for those that are going down the path of building portfolios for those in retirement and pension phase. There are ETFs available, and this is not an example of building blocks, but more solutions in their own right. There are ETFs that actually capture that Milliman risk management strategy and that are very easily accessible. This is an example of what we call the democratization of investing, that institutional strategies like that Milliman risk management strategy were previously the domain of only big institutional investors and pension funds and insurers, but they're now available very easily in an ETF format. On the fixed income and cash side is very interesting too, because here's a listed fund, and being listed, historically a lot of investors would think that's just equities, but there are ETFs and exchange traded products that have fixed income exposures. It's interesting with the way expectations of interest rates, you'll be hard pressed to find an active fixed income manager that hasn't brought in their duration and rotated into floating rate bonds. It's simple bond maths. Rising rates, you will have a loss with your fixed coupon longer dated bonds. So they're now shorter duration floating rate only exposures. So it's allowing you to actually implement that view and decision rather than maybe go through an active manager to get that same exposure. The short funds also have been very widely adopted, and these simply allow very easily and simply to hedge your portfolios, particularly if you believe volatility and the markets are going to pull back. Traditionally, what you'd have to do is either sell your assets, crystallise a tax event and give up dividends, but that doesn't need to be the case now with these short exposures. And I've mentioned the active ETFs, which we believe certainly is the future for exchange traded products on the ASX. I'll pause there. Wes, I'm going to come back to you in a moment. And I'm going to hand over to Rob now from Chartreux. Rob, it would be great for you to share with the audience. It's been several years now that you adopted a managed account solution. You've also put in place an investment committee structure and also put in place, and in practice I should say, your own investment philosophy and beliefs as part of a portfolio construction process. I'd be really keen for you to share with the audience your journey.
No problems, Vinny. I'm going to stand up because I need the oxygen to get to my brain, plus I can't read that far. So Chartreux Wealth is, I guess, we're a dealer group licensee who has just evolved out of the last few years. We've got a whole different range of skill sets within our community. Some people don't touch investment management at all. Some people are very experienced in investment management. Some people don't know how to spell investment management. So what we had to do was come up with a solution that was going to enable everyone to be able to deliver the advice to their clients in an environment that was going to satisfy the need to give them the absolute best possible solution. And when we started looking at the MDA, we were a little bit excited, but then we were sort of, we weren't quite sure. We weren't quite sure whether these benefits were going to be as good as what they actually were. When we actually started getting into the process of setting up our MDA, it became pretty apparent pretty quickly that this thing was going to transform our business greatly. It exceeded all of our expectations very, very quickly. We have a philosophy in our business. The principles of the business are very investment focused, and our investment philosophy is something that is paramount to our license and the people that operate within it. The MDA provides us a mechanism to be able to provide consistency and a timely solution for advisors and clients alike. We have a core satellite approach. We have a passive component to that. We have an active component to that. We also have a very strong belief in correlation of assets, and even though we find it's in every textbook, we find that most people actually don't transcribe to the view of investing in really uncorrelated assets. The ultimate letdown to things such as platforms is the cardigan wearers that effectively limit your ability to invest in the sorts of assets that sit outside T+2 type arrangements, which effectively means when we have GFC type events, we have a correlation of assets of around about 1. We've seen it.
Who would you be referring to there?
Oh, no one in particular, Vinny. I'm a working advisor. I sat in the front line in the GFC. I had real conversations with clients. And at the end of the day, the only thing clients care about is delivering their objectives, which includes a sustainable income and a preservation of capital to some degree. So we actually felt that the system was broken and wasn't delivering what our clients needed, so we went to reinvent that system. And the process of setting up the MDA was one in which it took us a long time to find a partner who shared our philosophy and was going to enable us to do what we wanted to do. It took us about a year to go through the players and then come to a selection of the people that we were going to join with. But once you've made that commitment, it's not necessarily smooth sailing in all areas, but at least you've got the understanding that you can do, in fact, what it is you're actually seeking to do. Guys have spoke about the efficiencies of MDAs and all that sort of stuff, so I'm not going to elaborate on that further. Exchange-traded functions, exchange-traded funds inside MDA. This product has been a real, it's changed the way we go about things dramatically. There's active, there's passive, there's broad, there's specific. The only thing that's going to limit what can be put in an ETF is the product provider's imagination. And their imagination is generally, it's generally sort of prompted by advisors asking them for solutions. So people like Vinny love it when people ring up and say, Vinny, I've got this great idea, go make it work.
Anything except Bitcoin. No Bitcoin.
Oh, you got my email, did you? So, I mean, ETFs are a fantastic way to do what we need to do. They're easy, they're cost effective to execute, they're transparent, and they're regulated. In our core, just to show the very simple ways that we can sort of use ETF products, the core component is, generally where traditionally, I guess, people have sort of said, I want a low cost, I'll just throw a cap-weighted index fund in there, and that's my core. And that's wonderful, and there's nothing wrong with that. However, what I think the advent of products like ETFs have done is they've given us a lot more variety in terms of how we can actually go around building things like the core. So, for example, we've got a certain view on the banks in Australia and where they're sitting at the moment. So does it make sense for us intuitively to have a position of about 40% of our core in those banks? Arguably not. So we simply have a equal weight ETF. And that dramatically reduces our exposure to banks in our core, but the underlying premise of what the core is doesn't change. As far as a real life client perspective, the advisor can sit there in the meeting with the client and crap on to their heart's content about why they don't like the banks and what we're doing about it. Wonderful. They've got a story to tell, and the client feels that the advisor is engaging with them personally and what's going on in the real world. There's no buying and selling. We're not switching out a NAB to A and Z, etc., etc. It's cheap, it's easy, and it's quick. The other component, obviously, that's probably more of a thing for our market is obviously the big end of town is pretty much the entirety of our market. So to be able to go and get exposure to things outside the top, so you can actually skew your core to things outside the top 20. So if you don't like Wesfarmers, Telstra, the banks, the miners, well, there's an easy solution for you. You can skew your portfolio very simply. You've still got your story to tell. Your investment performance will reflect the fact that you've got that view, but it's a very simple view to implement. We've got a whole range of filters that can be applied to investments such as the core. As Vinny alluded to, instead of just having simple things like market weight, market capitalised indexes, we can have particular filters. So for example, our view of the world is there's probably a little too much debt out there at the moment. So there is actually filters in ETFs that you can actually utilise to reduce your exposure to such companies. To us, that makes sense. The old adage that, well, it usually applies to property, but for the sake of the presentation, I've used it for shares. You can't lose money in shares, so why don't we increase the leverage? We could, if we want to, get a geared exposure, very simply, to the market by using a geared ETF. Okay, you'd have to be pretty bold to be able to do that at this point in time, but it's nonetheless, it's an option. In regards to our satellites, so once we've got our core positioned how we want it, we then look at our satellites and what we're doing in regards to our satellites. A couple that we've got here, we had positions in Japan, and we also had a position in Europe. So in terms of our international exposure, by simply buying an ETF for a small portion of that money, you're effectively skewing your portfolio, taking a satellite position to reflect that view. It's done with one trade, it's done very easily, it's done very cheaply, and it's done very efficient. And as soon as the Japanese government put out a press release saying, we anticipate that the popularity of Bitcoin will mean that our economy will grow by 0.3%, you can then get in and sell the Japanese exposure very quickly, and everyone's got the benefit of that. In regards to hedging, this is, I think, a tool that a lot of people will be using at the moment. You can actually take short positions in your portfolio to manage risk. You can also do it, obviously, to take a view, a speculative view. But in terms of, we use it in regards to managing risk. There's a whole range of varieties where effectively you can get 1-for-1 exposure or about 1-for-3 exposure. So by owning a 10% exposure to a short, we can actually protect a third of our portfolio. So these are tools that, once again, you can very quickly utilise to see your investment philosophy to fruition. It enables you to actually deliver what you are saying to clients. There's also the opportunity to take positions in pretty much anything. Things that we've done things like gold. We've had exposures to gold, be it the physical and be it gold miners. So once again, it's the imagination of the product providers that is the thing that limits what your ability to do in this stuff is going to be. In regards to the other thing that I think something, as I said, we're into uncorrelated assets. I think another big thing that's coming into play, which I'm very excited about, is the advent of technology and being able to access different forms of assets that traditionally we haven't been able to do. We actually use the Domicom platform in our MDA, and hopefully this is not a repeat of the BT Time Fund that effectively flagged the end of the tech boom, but we're actually looking to do some direct property transactions in that, which will include providing both the debt side and the equity side. That is going into our MDA. That is going to give our investors the ability to participate in assets that are going to give them an entirely different risk-return profile to what they can get elsewhere. So I think the MDA as a structure is the bee's knees. I would go as far to say that everyone will be using them in 5 years' time. If you're not on it, get on it. Well, thank you for listening.
Thank you, Rob. Thank you, Rob. Might throw over there any questions either for myself or for Rob.
Rob, just a question. How long did it take you to implement, and how many clients, as a percentage of your client base, have you got on the MDA?
Yep.
Repeat the question, Rob.
Okay, the question, well, paraphrasing, the question was about how long did it take us to implement the MDA and transfer our clients over to that platform. As you guys know, that sort of stuff's got a lot more difficult under best interest. So there is other hurdles that you need to sort of be considering. So basically what we did with our clients is we had a lot of clients with direct equity exposure. So in theory, if you moved a client from a direct equity portfolio to a MDA, potentially what you've done is you've increased the cost to the client. So there was a bit of an issue around that we basically sort of thought we won't deal with that from the start. So what we did is we attacked the low-lying fruit, and things that we could move into the MDA immediately and get an immediate benefit without necessarily any disadvantage, we did that pretty much straight away. And then what we found is over time, the clients were then very comfortable with the MDA structure, and then effectively enabled most of the other assets to come across to the portfolio. In saying that, we still do have a fair amount of assets outside the MDA structure in terms of assets that we can manage. But it does take a while, but it's once you actually do it, it's an investment. The time you spend doing it, you get the payoff thereafter. And as long as you're saying to clients, this is the benefit for you. And invariably, the most common thing people were saying to myself was, well, I always do what you tell me to do anyway, so if that means you don't have to ring me up, fine, do it. And that's the reality. So that's how we transferred clients over.
Which is, we saw Sam Henderson talking about charging for portfolio management. In Chartreux, do you charge explicitly for the portfolio management service?
Yeah, we do. We've got an internal investment committee because we've got our own process philosophy, hoo-ha. We've got an independent that sits on our board. What we do is we charge there was two prongs to this. There was Also, from a licensing perspective, from the AFSL perspective, I didn't want to put any impediments in the way of the advisors from using our MDA. So, for example, we had best interest, right? So what we did is we have a very low fee. We have a 0.15 management charge, and every strategy is benchmarked, and if we beat benchmarks, we have performance fees. Okay, so if we don't beat benchmarks, we don't get performance fees, and obviously the cost is quite low relative to what's in the market. And that was done deliberately, it was done by design, because we're not necessarily in the business of running an investment management business. It actually served a couple of other purposes as well.
Just one last thing. So Rob's obviously gone down the path of formulating his own philosophy and model. That is one option that Chartreux have taken. Another option is, if you choose not to do that, is that there are professional consultants that you can outsource to. There are a few here: Morningstar, Zenith, Lonsec, Quilla Consulting. There's a whole range of professional asset consultants that can help you with the portfolio construction. Another third option, that's a very interesting one we've seen in recent times, is given like a Chartreux has gone down that path and set up their model portfolios, and it's sitting on a managed account, it means that other advisors from other licensees are able to tap in just for that portfolio, model portfolio. So some interesting options there.
I actually had a question too, Rob. The clients that go a little bit free range on you. So I imagine there are some clients most of your clients buy into the MDA. I imagine there will be a percentage of your clients that don't want all their assets held inside the MDA or reject that. How do you treat them, service, value, price wise?
Yeah, look, I mean, clients are clients, right? So we've got, we've got a number of clients that actually don't know what the MDA is, right? They think because they're putting it in an MDA, it's like, oh, I want to see how it goes. I want to make sure it's, I'm going to get my money back. And it's like, well, it's no different to if you put it in another platform or if you do it directly. So they get, clients are clients, right? As far as, we have a very definitive service offering. So from an advisory perspective, we have a fee that applies. If you want to invest in the MDA, that's fine, and there's fees that will apply to that. Alternatively, if you don't want to invest in the MDA, well, then we will structure a different type of arrangement. It gets back to, and I think one of the speakers earlier on in the day said, you've got to get paid for what you do, and it's the same principle.
Very good.
But I'm also very straight up with clients and say, we will not beat the MDA because it's physically impossible. If we have 100 people that we have to deal with directly, as opposed to using the MDA is a more efficient and it's going to be a better outcome. The other thing about the MDA is we can access opportunities that retail investors aren't going to get off their own bat.
Yep.
So.
Very good. Any final questions for Rob or Vinny? I think that winds us up, gentlemen. Thank you very much for a fantastic session. Really appreciate it.